Most traders stay stuck on strategy, and it's one of the big reasons that most traders are losing money. They think it's the answer to profitable trading. They believe if they build an edge great enough, they'll never have to deal with risk management and psychology. And what's worse, they believe they have to build that edge in an extremely complicated and complex way. I believed that exact same thing for years, and it nearly ended my trading career before it ever got started. This is part 2 of a 5-part mini-series where I break down what actually separates the traders that never make it from the ones that do. In episode 1, I laid out the big picture, why most traders never make it, and the 3 pillars that I believe this comes down to: strategy, risk management, and psychology. In this episode, we're going to dive deep on the first one, strategy, the one that almost everybody obsesses over and the one that almost everybody gets wrong. I'm going to break down what I and most traders get wrong with strategy, the shift that changed everything, and the core fundamental pieces that I build from today. Finding and creating an edge using discretion within reason and dynamic trade management. I'm going to break down what I got wrong about strategy, the shift that changed everything from me, and the core pieces that I build from today. Using your discretion within reason, finding and creating your own edge, and dynamic trade management. And stick with me to the end on this one because I put together a comprehensive breakdown on my strategy. I give you everything start to finish with live examples, and I'm going to tell you exactly where you can get that for free. But don't jump to go grab that right now, otherwise you're going to be exactly who I'm describing in this video. You're going to miss the core context of the strategy we're talking about. And before any of that, one thing you should know is this is not just theory. This simple discretion-based strategy is what's kept me in prop accounts taking dozens of payouts every single week for as long as I can remember, and in live prop firm accounts consistently over long periods of time, again, taking dozens of payouts. Not a complicated strategy, not a complicated system, this. Let me show you how I got here because I started off in a horrible spot where you might be right now. For the first few years of my trading, I not only believed that strategy was the answer, but I believed that it had to be very complicated, very complex. I used to think, how could something simple justify extracting money from the markets over a long period of time? So I did what everybody else does. I went on the hunt for information, new strategies, new indicators, more information, more overlaid indicators on my chart until it looked like a lit up Christmas tree in the classic meme examples that you see. I added dozens of rules, dozens of confluences. I made things extremely complicated. I was told, maybe like you were, that we're supposed to be machines. We need a 100% objective rules-based strategy so we can take ourselves out of the equation. Some magic combination of tools and price and time that's going to allow you to execute every single day the exact same way and extract money from the markets in the way that a bot or an algorithm would. All that did was confuse me. Information overload, decision fatigue, and led to nothing but consistently losing money. But everything shifted for me after another losing session. At the time, I was putting so much effort into becoming profitable, I was waking up in the middle of the night to trade London session here on the Eastern time zone, and I was working a full-time career during the day. And it was at the end of another frustrating back-to-back losing session where I had been read day over day over day that I decided to do the tough thing that I was avoiding doing at the time, looking at my equity curve. It was a straight shot 45-degree angle to the downside. I wasn't the blow-up king, but I was the slow bleed back-to-back-to-back losing trade king. And I remember that in the middle of the dark, cold night, looking at that chart in really disgust, despair, disappointment in myself, a cold, hard fact that I had been heard repeated by other coaches that I was starting to work with. I was doing significantly worse than entering randomly with a 1-to-1 risk to reward. Now, I want you to think about that. In completely random market conditions, with a 1-to-1 risk to reward, entering randomly, holding all the way to a take profit and a stop loss. Less commissions, fees, spreads, anything that would eat into that. You would be break even with a 50% win rate. And looking at my equity curve, even with all of those real costs added in and maybe non-random trendy market conditions, I would have been way better off had I been flipping a coin, entering randomly, instead of spending all my time and energy pouring it into a complex strategy. And even with all of those real costs and non-random market conditions that maybe are trending, I would have been way better off, way closer to break even, had I been flipping a coin and entering randomly, holding all the way to a take profit and a stop loss, than my straight shot to the downside equity curve. I was so far from the edge that I thought I was constructing with all that time and energy and effort that I was actually taking away from the one simple fact we're up against when it comes to the math of what we're doing here. We need to create a positive expectancy over a large sample size of trades through some combination of win rate and risk to reward that gets us past the natural break-even win rate. That's it. I had watched some videos on that. I had been told that before, but it really didn't sink in until that moment. And that day, I decided enough was enough. I had nothing to lose. I couldn't possibly be doing worse than what I was doing right then and there. So I stripped my charts of every indicator I had, everything, just candlesticks. Went back to complete basics, trying to identify areas of interest on my chart to enter, using a 1-to-1 risk to reward, and letting the trade play out to a full take profit or full stop loss. And quickly from there, I made a decision that felt like heresy to everything I knew at the time. I decided to actually use my discretion, my experience, my subjective interpretation of price action and market structure that I had built through hours on the charts. And lo and behold, this worked. I was blown away. My results immediately improved. I went from consistently losing money, where most traders are, to right near break even and quickly ready to tip the scales in my favor. Now you might hear that and think, break even, that's not making money. We're here to make money. The cold hard truth is that if you are break even, you are doing significantly better than most traders. Most traders are losing money. They are nowhere close to break even. And actually getting to that break even point rather than creating some insane edge was where I needed to start. That put me ahead of most traders and gave me the baseline. I finally had a floor that I could start building from. And from there, I pushed it further. This is where the pieces that I build from today come into play. Finding and creating an edge. I clarified my entry criteria, my chart setup, my markup, but I still left room for discretion. I got clearer on top-down analysis and utilizing the tools that I still use today: price action, market structure, volume. The answer was not 100 rules and confluences. The answer was something clear enough to keep me consistent day over day through very random market conditions on the short term that still allowed me the freedom and flexibility to utilize my discretion, utilize my experience. Discretion within reason. This is the part that almost nobody talks about because it's easy to sell you some magic system. See X, do Y, make $1 zillion. Building some structure so you can apply consistency and then utilize your discretion, your experience to your advantage. There's a massive amount of edge in human traders' discretion so long as it's kept within reason. Dynamic trade management. When I started this experiment, I ran every trade with a fixed 1-to-1, a nice wide stop loss and take profit, and I let it run. Then I quickly started to ask another question. What if I started to apply some discretion within my trade management on trades that seemed like they were working well? Could I hold my winners all the way to the take profit, maybe even a little bit further? On trades that started to quickly move against me, that looked like they were not likely to work out, could I close them out a little bit early? Could I clip them before the stop loss? Could I do what everybody tells you to do? Let your winners run and cut your losers early. And if I tracked all of that, what I was doing and why, what was working and what was not working, and tried to do a little bit more of what was working and a little bit less of what wasn't, could I shift a genuine edge in my favor over a large sample size? The answer to that question was a resounding yes. That was the shift. That was the change in my strategy that allowed me to push into the green. I was able to start pushing my win rate past that 50% and my risk to reward past that 1-to-1. I started to create that positive expectancy and string together green days and green weeks, something I had never seen before. I had to truly let go of the belief that a 100% rules-based, objective, complicated system was the answer, and that there was a ton of edge to be built and utilized within disciplined discretion. Keeping it simple and applying my discretion within entries, within trade management is what's allowed me to build to where I am today. I've got some more on my charts these days. I do use some more advanced tools like order flow software, but this is the core belief that I apply, the lens that I see all of the tools that I use through, and something that I continue to return back to. Remember what I said in the first video. The space continues to change. Prop firm rules change rapidly. Markets change very quickly. Applying my discretion, reviewing regularly, and keeping things incredibly simple is exactly what allows me to continue to review the changing landscape, see things for the context that they are, and continue to adapt. I don't have something so rigid that when one thing changes, everything breaks and I'm completely lost. I believe that simplicity survives. Simplicity gives you the ability to adapt. I'm going to go a little bit further with this. Trading is a lot like learning to ride a bike in more ways than one. When you learn to ride a bike, you needed the basics, the mechanics, where the pedals are, how the brakes worked, how to turn the handlebars. But past that, you didn't continue to study bicycles, the history of bicycles, lean angles, the force of inertia and gravity. You certainly didn't watch hours of YouTube videos on professional cyclists racing every day. You hopped on the bike, you tried, you fell off, you got a feel for it, you started to learn through experience. And if you were lucky, you had somebody there that helped you, someone who already knew how to ride a bike. You weren't there just to watch them ride the bike, although that might have been helpful at first. They were there to give you the basics, get you on the bike, and then help you as you started to ride. Watch you ride and give you feedback in real time. To yell at you to slow down when you came into a turn, to turn the handlebars, to hit the brakes, to put your foot down when you started to come to a stop. And most importantly, to pick you up after you fell off and scraped your knee. That's the difference between studying trading forever and actually learning how to trade. And the difference of learning to trade alone and working with a one-on-one coach that's going to provide real-time feedback over an extended period of time. So here's what I promised you at the start, a deep dive into my strategy with live examples. I've dropped videos inside of the free Discord, which is linked down below this video. You'll also find a link to book a call if you are somebody that is dedicated to getting profitable at trading and you are looking to work with somebody who is dedicated at helping you at a one-on-one level. Be more than happy to talk to you in a free call to discuss your trading. Book a call down below, answer a few questions, and I'm more than happy to talk to you. And if you found this video first, you haven't watched part 1 of the 5-part mini-series, go back and watch that one where I lay out the overview here, the big picture of what we're looking at. If you watched that one already, get ready for the next one. I'll link it up right here where we are diving into risk management. I'll see you there. Quick disclaimer, guys, I'm not a financial advisor. I don't provide financial advice. Nothing that I say or do is a suggestion or recommendation to do anything at all. Trading is extremely risky and most traders do lose money. If you trade, you're probably going to lose all of your money. It's a crazy thing to do. Make sure you also read CFTC Rule 4.41 on simulated trading, which is what this is, even if under prop firm accounts, and the affiliate partnership disclaimer that says I stand to make money from links and codes in my content. Can't be unbiased if I stand to make money, which I do. Important for me to note that, for you to do your own research and make your own decisions. Make sure you read the full disclaimers down below this video and at realdealfutures.com, realdealfutures.com/privacy terms. See you guys in the next video.